Hello all. What if I told you that there is a financial product that probably most of the people haven't heard of, one that could potentially deliver a significantly higher return than that of the regular savings account or CDs? Of course, I'm not talking about volatile stocks or speculative options. It sounds interesting, right? So today I'm going to walk you through exactly what this particular product is about and break it down into simple, clear, and practical ways so you can decide whether it fits in your financial strategy. This is Arvind Varganti, and you are watching the Personal Finance Coach channel. So, this is the financial product which I'm referring to. Notes. Note in simple terms is a written IOU. When you invest in a note, you are lending money to a government or a bank or maybe a company. In exchange, the company promises to pay you a regular interest and return your original money. That's the principal on a specific end date. That's the maturity date. Notes are very similar to bonds. Probably you would have heard about bonds. The main difference is that notes usually have a very short lifespan, often lasting from a month to say a year or maybe a couple of years. But whereas bonds can last for maybe a couple of even decades as well. Especially you would have heard about treasury bonds, which last for say 30 years. So today I'm specifically talking about notes which are issued by a company called Ground Floor. So Ground Floor is a REIT company, and if you are not familiar with what REITs are or how they work, then I have linked a detailed video in the description that explains them in depth. But at a high level, REIT companies pull money from the investors and they use it to buy, manage, or finance real estate, including providing real estate backed loans to the various borrowers. Now, let me show you this company. So, let me just get into Google. So maybe you can search for company Ground Floor REIT. Yeah, this is the one, Ground Floor. So this company uh, has issued fixed income notes, which are also called as a promissory note. So if you scroll down, you can see there are three notes: the 12-month note, 3-month note, and 1-month note. So if you go for 12-month note, so they are guaranteeing you 8.5% fixed APR, and 3-month note is a 6% fixed APR, and the 1-month note is 5% fixed APR. And again, of course, your interest would be paid monthly, and rate is locked for 12 months. And at maturity, you can roll over or withdraw at maturity. And the minimum investment for this 12-month note is $1,000, whereas for 3-month note, this is the interest, and pretty much your interest is also, I mean, in this case, the interest is paid at maturity but not paid monthly. And rate is locked for 3 months, and again at maturity, either you can roll over or withdraw at maturity. This is the minimum investment, which is $100. And same is the case for 1-month note, which gives you 5% fixed APR. Interest is paid again at maturity. Rate is locked for, of course, the 1 month. And at maturity, you can roll over or withdraw at maturity. And the minimum investment is $100. So again, definitely, this gives you a little bit higher return compared to that of your savings or CDs. And again, to summarize, so these are all the key features of ground floor notes: fixed interest paid every month, and the at the end of the maturity, either you can roll over into a fresh note or you can withdraw at maturity. And the of course there are minimum investment thresholds which you have seen there. And the good part is these investments are secured against the assets of the ground floor. Okay, so this also comes with some risk. So obviously, the higher the risk, the higher the return. The lower the risk, the lower the return. So ground floor also comes with some risk. The money is locked for the entire duration of the note, so you cannot withdraw your funds typically before maturity. And there is no FDIC insurance, so you have FDIC insurance for your funds in your bank or your CD. So if the banks go bankrupt, then you get money from your FDIC. But with the ground floor, you do not have that FDIC insurance. Of course, we also have the default risk. So ground floor generally typically lends our money to the borrowers, and these loans are generally secured by the borrower's real estate. However, if the borrower fails to repay and ground floor cannot recover the full principal even after selling the property, our investment might be at risk. And every investor risk levels are different. So hence do your own due diligence. And if you feel you are interested in the secured notes, then you can create an account at ground floor and start investing the money. You can also check the description section for my referral link. I had invested in these notes. So investing through my referral link can provide you a bonus of $50 for a minimum investment of $100. Thank you. Thank you. Thanks for watching my video. For interesting videos on personal finance, please do subscribe to my channel. And if you feel that you learned something new, please like and share. Thank you.